Hey, good morning. Julie with J Trading Strategies. One good thing about statistics is that we learn how to measure everything, and so we start thinking of relational ranges and structures and data often and how they model into these curves, especially with this coronavirus curve. Everybody's trying to flatten the curve. Um, but you have to learn what a normal distribution would look like and know when the data is trading outside the distribution and whether you're into a 2 time range opportunity or a 3 times range opportunity of when data is, moving directionally outside of a range. And that is always caused by volatility. And we've had volatility spikes, historic levels of 80, 50, 60, 70, 80 certainly is outside 13 and 12, right, where we had been. So understanding that there is structure in the markets and normal distributions that algorithms are normally tied to. And so an algorithm knows when it's trading 2 or 3 times from a range, and that's all that they can do really. Um, they're not really tied to levels, like they don't put 2450 in as the level to stop at. They trade in these ranges and multipliers of these ranges. Multiples of these ranges is what I'm trying to say. So just knowing, obviously, that we're way outside the range, like at a multiple of like 6 or 7 or 8 currently, it can continue moving directionally to the downside without stopping at any particular level. So I would not be concentrating so much on worrying that 2450 didn't hold, for instance, because the market's liquidating and there's nothing you can do in liquidations. They just sell out. And so thankfully, we have an excellent, healthy economy before this. This is a temporary situation, so we're going into a um, temporary shutdown, which means that the markets should be flat. And that's why I'm really a proponent of the Fed closing the markets myself, because there's just, if you liquidate, you just don't want the stock to drive to zero, right? Which could happen as everybody pulls their panics, run a run on the bank, right? So here's what a normal distribution looks like. You see prices inside the white boxes. Inside the white boxes is the middle. And anytime you're in the middle, you're normalized inside the range. So you're rotational up and down. So really this entire area is your risk. You need to be trading at least a multiple of 1 of that to be safe, right? Up or down. And if you have to trade inside this box, you damn sure better get the direction right because it's non-rotation. I mean, it's non-directional. You're, but at least you have a measured, known risk and a normal structure. What we're experiencing are 3, 4, 5, 6, 7, 8, 9, 10, 11 breaks of that multiple. So do you see how nice the trend, the volatility level, the ranges were all in alignment? That's your sweet spot. That was in December, the Santa Claus rally. And then we roll over, got that break of volatility, and staying within the ranges, get to the bottom of the range, it bounces. Um, Here is where you get outside the range, but we're still within these structures. So if we measure the box, we can move it 1 down. And do you see that? It's like magic. That's where the market makers will be looking to get back in a direction to go back in. So that's why having the ability to create your range to match what the market is doing is so important. So we're able to do that with these PT indicators by your bell curve indicator, really, by setting your own timetable. This is the RTH session, Chicago time. You can turn it to a daily or a weekly or a 60-minute or a range or anything that you want to change it to. I would just leave it on the RTH, standard day trading framework, and it works really good. But the problem is when these little normal 35 to 50 point ranges, generally 33, 25, um, start growing in multiples of 3, 5, 7, 9, 12, 15. And that's what we're seeing today. You see how we got to the bottom of the range? And look what happens. Algo started hitting it. This, lather, rinse, repeat. Well, we've far left this land of the Fed put. And that doesn't work anymore. So see, that was a great little sweetheart trade there. We started breaking down 2 times the range. Here we broke down twice. Here's the first range. Right there. And then we did it again. Right there. Came back in towards your volatility. And just trading these multiples of these ranges, still somewhat working, although the ranges are expanding. See, this is where the algos come in. So it's still lather, rinse, repeat, February, right? Another nice one. And then the hell breaks out. And so we got to just launder, rinse, repeat, but to the opposite side, we need to be selling those tops. So we broke out and the ranges are expanding like, let me open this up. Multiples of, like I was telling you about, 2, 3. So there's one. Might as well start drawing some lines. And then we gapped. So the range here was the same size. Do you see that? Here's one more. Not even near finished. Our range expanded. Got even bigger. Look at that. Walking it down. Right? So you know where it's going to go. Are y'all picking up on that? Have you figured that out for your target line to trade to? And then reverse it. Right? Because we're still on some semblance of that algo. But as you see here, it cost you a little bit to get in that trade for the first time. All right, took it back up to the PT1B, turned it back around, and then, like I said, the floor is gone, baby. Gap down breakdowns. You can see the bank panic. Bank panic, all the wicks trying to, act like a cockroach being flushed down a garbage disposal, right? They're trying desperately to get out, and it's not going to matter because they're going to get flushed. There's your M, and boom, there they go in the disposal. Boom, world comes apart, lock limit, everything's out. The national media finally picks up on what's going on, and the markets panic and the liquidations begin. And this is where everybody picks up the phone and wants out. All right, and you see how here was the bottom again. So we're still holding, right? Are y'all seeing this, guys? Okay, just checking to see if you're still breathing. Okay, and then down here, do it again. It's just crazy. Right here. And they even got robbed. Look at that. They even look, they got rolled over. So that one got squashed and then a big never mind. So I guess the re-entry would have been right here, but then it takes off. So they even got killed in the volatility. So our little algo got squashed. But then this is the liquidation. Look at this. This is just meltdown. This is just people calling, canceling, get me out, and the Fed trying to uphold the market at the same time. So I think the markets right now are just wide volatility. Remember our 30 point, 40 point boxes up there? Are you kidding me? 291.50. 291.50. 31, 291. That's an 11 multiple. 11 times our range. I would say we are just, you know, crazy still, crazy land. So, don't know what to expect next week, but the markets are not trading normally, to say the least. So be judicious, understand the ranges. Maybe you can, be preemptive, draw some range boxes to the downside for targets. Once it starts leaving that range, you at least have a plan of where to trade to. You're not just gaping at the floor. So here we're walking it down, and let's see. Yep, the range is still the same. And now we have a new range box building. So blue to blue. Yep. Blue to blue, and then underneath the blue, this is what we're looking at. 1825. Oh shit. And here's your trade. You can just move this over here and be ready, right? That's you. That's us. All right. This is Julie J. Auto Trading Strategies. And not looking good out there. Take care.